Welcome, everyone. In today's webinar, we're going to talk about the financial implications of divorce. Quick disclaimer, this webinar is for educational purposes only. It does not constitute legal, tax, or financial advice. All right, so a little bit about myself. My name is Marc Bautis. I'm a wealth manager, founder, owner of an RIA in Montclair, New Jersey. And looking forward to talking and giving some tips on how best to go through or prepare to go through a divorce. So if you're attending this webinar, statistics on divorce, they may not come as a surprise to you. While it's sad to realize how many families are impacted or affected by divorce, it can be reassuring to recognize that you're not alone going through it. Divorces are complicated and they're challenging, to say the least. And that's a major reason why divorces often take years to finalize. So when it comes time for you to address your future financial well-being, you probably have a lot of questions. And these are some questions. They're just the tip of the iceberg when it comes to what people are asking or thinking about when it comes surrounding a divorce. Things like, how do we value our property? Who gets what property? What are the tax issues? How do we divide retirement funds and future pensions? How will a lower earning spouse survive financially? And there's many more. Financial problems can tear a marriage apart, and they're often one of the primary causes that can lead to divorce. If couples cannot solve their financial problems during the marriage, how will they be able to agree on financial issues during or going through a divorce? So it's important that you're well informed on how to approach it. That's where this problem comes in. Attorneys often struggle with the intricate financial details in the divorce, such as tax issues, capital gains, dividing assets, including, complicated things like businesses or pensions. Attorneys, they go to law school, they become experts in the law, and a lot of times not necessarily to be financial experts. Additionally, even if an attorney does have significant financial expertise, they're not allowed to testify on behalf of their clients. So due to these financial complexities and the role that they can play in getting the most equitable settlement for their clients, more and more attorneys are bringing financial experts into the divorce process. So the role of a financial advisor, it's to help people achieve their financial goals, regardless whether they're divorcing or happily married or not married. A financial advisor assists both the client and their attorney in understanding how financial decisions that they make today will impact the client's future based on some certain assumptions. So as a financial advisor, we're trained to interview clients to do a variety of things, such as collect financial and expense data, help them identify current and future financial goals, develop a budget, set retirement objectives, determine how much risk they're willing to take with their investments, identify what kind of lifestyle they want, determine what kind of education or how much education they want to pay for their children, and so on. Now, we're able to execute on those needs and goals, as well as the divorce-specific help, such as understanding the short and long-term effects of dividing property, analyzing pension and retirement plans, determining the cost basis and capital gains on the sale of a marital home or investment property, determining earning capabilities, and things like establishing assumptions for projecting inflation and rates of return in the future. So first step is you want to gather all your important documents and information. And, we know that going through a bunch of files and organizing financial information is obviously not the most enjoyable activity. But when it comes to divorce, it's a non-negotiable. It's critical for a few reasons. First, you need to prove what your financial situation is. The court obviously is not going to just take your word for it. Also, creating a budget, it's really essential. And having all the information together, it's really the only way to put together an accurate one. Figuring out what's jointly owned, what's owned individually, what your spouse owns. You want to do that as early on as possible so that you know what you're entitled to and what may be part of the divorce settlement or what you may have to fight for. So a financial affidavit, it's a key document used to collect financial data in divorce proceedings. It's sometimes known as a financial statement. What's included in the affidavit are income and deductions from your income, living expenses, assets, liabilities. This document becomes part of the record of documents that's filed with the court, and it's a sworn statement that's notarized. So many states have a standard form that can be used to collect this financial data, and you obviously want to check with your state to determine, what their required procedure is for reporting financial information. Step 2, invest in professional advice and assistance. I gave a quick disclaimer about all the different, you may need legal advice from a family law attorney, tax advice from an accountant, financial advice from a financial advisor, and then obviously support from either a counselor or a therapist. So this step, it can obviously be scary because you want to feel confident that the professional is someone you can trust. So we have a list of trusted professionals in each of these areas. And you're more than welcome to reach out to us for any friends, family members that have experienced divorce or going through a divorce and ask us for recommendations. All right, step 3, you want to take inventory of your personal property. When looking at the property and divorce, number of different issues have to be considered. So what constitutes property? What actually is property that would be part of the divorce proceedings? What's the difference between separate versus marital property? How do you inventory the assets? And then what happens if you have to find, or how do you find hidden assets? So let's address each of these. So first, what constitutes property? So property includes assets like the family home, rental property, cars, boats, arts, antiques. It also includes bank accounts, mutual funds, stocks, bonds, life insurance, cash value of life insurance, IRAs, retirement plans, stock options, non-qualified deferred compensation, and family-owned businesses. So as you can see, there's really no limit on what's considered property. Next, you want to look and determine what's the difference between separate property versus marital property. So in some states, regardless of how the property was brought into the marriage or whose name is on the title, all property of both spouses is subject to division and disposition at divorce. So these states, they don't differentiate between marital, non-marital, or separate property. However, the source of the property, it may be a gift, an inheritance, or something that was owned prior to the marriage. While ignored when classifying the property, it may be important to determine how that property will be divided. So all states generally divide property to try and achieve fairness. The difference is the starting point and the rules each state uses to reach that fair result. So for example, some states start from the standpoint that all property is subject to division by the court, and then, depending on the circumstances, they give property that was owned prior to the marriage or was acquired by gift or inheritance to the party that owned or received it. So other states start with the notion that such property is not subject to distribution by the court at all, and thus narrow down the issues to be decided. So although the laws can vary state to state, property is usually divided into just 2 categories, separate and marital, or sometimes called community property. And in general, separate property includes what a person brings into the marriage, inherits during the marriage, or receives as a gift during the marriage. And then marital property is everything acquired during the marriage, regardless of which spouse owns the property. So next commonly asked question about property is, how do we inventory all these assets? So here's where the financial professional can be of big help. And you really want to begin this stage to identify, collect, and evaluate all of these assets. So there's several documents that can assist us in this process, which we previously discussed, is really you're building this financial affidavit. So then finally, how do you find hidden assets? The divorce process it's a time of mistrust for each spouse, right or wrong. Each may accuse the other of hiding assets. Assets are traditionally hidden in one of these 4 ways. So either one or the other denies the existence of an asset. Assets may be transferred to a third party. The person claims that the asset was lost or dissipated, or the person may create some kind of false debt. So there's some logical areas where financial expertise can help generate the facts and then identify or find hidden assets that are out there. So tax returns are the first place you want to look for to discover the hidden assets. And you want to look, for the last 5 years of tax returns. You can use the first 2 pages of the tax return as the table of contents, but you really want to get into the nitty-gritty and look at some of the following forms and schedules. So you have like Schedule A, itemized deduction. It may help identify unlisted assets or sources of income. So for example, property taxes may reveal property like a boat or one spouse does not know exists, or gambling losses would reveal that they're gambling winnings. Schedule B shows interest and ordinary dividends, which identifies assets and investments generating interest and dividends. Schedule C, profit or loss from a business. So This may be a place where, a form that's used to hide assets or income. So for example, depreciation expense, it's not a cash outflow, and should sometimes be added back to the net income to determine the actual income. So the depreciation schedule may also reveal additional assets in the business that the business has. Schedule D, capital gains or losses. So this form is used to report gains or losses from the sale of any type of asset, stocks, bonds, real estate. Schedule E shows supplemental income and loss. So this is used to report income from rental property, royalties, partnership, S corp income. Form 1065, it's used to report partnership income. So you can see maybe one of the spouses has an interest in a partnership. And then forms 1120 and 1120S are used to report corporate income. You obviously also want to see if you can pull up any 1099s, W-2s, amended returns, inventory as much of this info as possible. And that can help piece together and see if there are any assets out there that maybe, you don't know about initially. So in the course of discovery, some spouses believe that their counterpart has somehow hidden or failed to disclose the existence of certain assets. So here we have is a checklist of research items that you can assist you in determining the whereabouts of these hidden assets if they exist at all. All right, in step 4, we want to talk a little bit about division of property. So division of assets in a divorce is dependent upon the statutes of the governing body of that state in which the divorcing couple resides. So, I mentioned earlier, states have adopted 2 different types of property division statutes, which could either be community property or equitable distribution. In community property states, the 2 spouses separate property is not subject to division of the court. So generally speaking, separate property, it's owned before the marriage or obtained by gift or inheritance. Everything else is community property and likely will be subject to a 50-50 split. So this statute, it's adopted in 8 states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Alaska are the ones that have adopted this. Equitable distribution states, on the other hand, usually agree that a couple's property, their marital property, it's divided between the spouses equitably or fairly. This does not necessarily mean 50-50. So most states adhere to this equitable distribution, and New Jersey, where we're located, it is an equitable distribution state. So here's a map of the United States that shows which states are equitable distribution states and which states are community property states. Okay, in many divorces, the biggest question is who gets the marital home? Should one spouse get it? Should the other? Should they sell it? Should they split the proceeds? What happens if the house is underwater, meaning that the homeowners owe more on their mortgages than their houses are worth? The answer, it's not always easy or clear. Generally, there are 3 options for the marital home. You can sell the home, you can have one spouse buy out the other spouse's interest, or you can have both spouses continue to own the home, which is probably of the 3 is the most complicated. So selling the home and dividing the proceeds is the easiest way to divide the equity in the home. However, the financial concerns that you need to address are the basis and possible capital gains, buying, what happens now? Are you going to buy another home? Are you planning to rent? Will you be able to qualify for a new loan? Then next you have buying the other spouse's interest in the marital home. This works if one person wants to remain in the home or wants to own the home, but there are difficulties with this option that should be considered. First, you need to agree upon the value of the home, or to determine what the equity in the home is. Next, you have to decide what the dollar amount of the buyout is. Will the buyout be reduced by projected selling clauses and possible capital gains taxes? In case the owner needs to sell it sooner than expected. Another concern comes up if there's a mortgage, and then what happens about taking one person off the mortgage. So let's say a wife wants to, or one of the spouses wants the home and both names are on the deed. The husband can transfer the home by quitclaim deed to her so that only her name is on the deed. And then she's now has title of the home and can sell it at any time. Although the name's on the deed and that takes care of that, there's the mortgage aspect that needs to be considered. The mortgage company may not care if there's a divorce, or they could refuse to release the other spouse from the mortgage. In that case, the only way the husband may be able to get his name off the mortgage may be for the wife to assume the loan, refinance it, or pay it off. And then if one of the spouse's name is kept on the mortgage, their credit may be impacted. Again, this one does complicate things, especially if there's an adversarial relationship when you have one person in the deed, two people on the mortgage. Then it goes the final option of just joint owning the home. And this could be an option for couples that want their children to stay in the same home until they finish schooling, reach a certain age, or if the resident ex-spouse remarries. The most logical way to split expenses is both spouses pay half of the mortgage payments, improvements, major repairs, and then property taxes, utilities, minor repairs, and insurance are paid by the resident spouse. Again, this is a complicated way to do it, and it especially if the relationship is adversarial, it could really be complex. Whether you live in a community property state or one that uses equitable distribution, retirement accounts are considered property that can be divided, or that most likely will be divided in a divorce, but only the portion of those accounts that's marital property. So as a general rule, contributions to one spouse's retirement account, along with the increases in value before marriage, are separate property of that spouse and wouldn't be divided in the divorce. In some states, the same would be true of contributions and increases after the couple separated. The part of the retirement account that grew during the marriage is marital property. One of the things that I want to leave everyone with regarding division of assets is consider the tax implications of each asset that you're splitting. Sometimes, I see, to keep things simple as possible, spouses agree to try and equate the dollar value of different assets and split it that way. So, I keep my IRA, you get the investment property because they have the same value, but the taxes that are owed now or in the future may not make it an equitable split as it was intended to be. Some assets may not have tax implications of them. Some may have capital gains associated with them, and others may have, be taxed at ordinary income rates. Especially like when you're looking at complex assets like businesses or, investment or rental real estate property where, they may have been depreciated and a lot of the tax may be owed, or, it's important that you talk to a financial professional, whether it's a CPA, a financial advisor, and you want to run what's a projection. And that shows, the asset over time and what's the value plus what is the tax implication if it gets sold, if it doesn't get sold at certain points. So I'd like to thank everyone for joining us today. You can leave any questions you have in the chat. If you go to our website, there's a link where you can submit any questions that you have. And also, if you'd like, we're happy to have a free complimentary call. You can schedule that by going to bautisfinancial.com/call. So thanks again for attending. We host these webinars periodically throughout the year. You are more than welcome to visit our Learning Center, and we have a lot of our webinar replays as well as registrations to upcoming webinars. And you can get to that by going to bautisfinancial.com/learning center.